The idea that successful investing requires predicting the market is one of the most persistent myths in finance. It survives every cycle because it appeals to confidence and control. If you can forecast where markets are headed, the thinking goes, you can simply place the right bets and wait. In 2026, after years of volatility, inflation shocks, and abrupt regime changes, this belief has become not only inaccurate, but actively harmful. Markets have made it clear that prediction is fragile. Preparation is durable. Professional investors learned this lesson long ago. They do not build portfolios around forecasts. They build them around probabilities, constraints, and structure. The goal is not to be right about what happens next quarter or next year. The goal is to own businesses that perform acceptably across a wide range of outcomes. In a world where economic surprises have become the norm rather than the exception, this distinction is no longer academic. It is essential. To understand how to pick stocks without predicting the market, we must first understand why prediction fails. Markets are complex systems. They are influenced by policy decisions, human behavior, technological change, geopolitical events, and feedback loops that interact in unpredictable ways. Even when an investor correctly identifies a macro trend, markets may already have priced it in. Worse, the timing may be wrong. Being early in markets often feels identical to being wrong. History is full of examples. Many investors correctly anticipated inflation in the early 2020s, but underestimated how violently interest rates would rise or how markets would react. Others predicted recessions that never arrived on schedule. The issue was not intelligence. It was overconfidence in forecasts. By 2026, it has become increasingly clear that markets do not reward correct predictions consistently. They reward robust processes. The alternative to prediction is structure. Instead of asking what the market will do, professionals ask what businesses can survive regardless of what the market does. This shift changes the entire investment process. It moves attention away from headlines and toward fundamentals. It replaces certainty with resilience. The foundation of this approach is understanding the cost of capital. In the decade following the global financial crisis, capital was artificially cheap. Interest rates hovered near zero. Growth was rewarded regardless of profitability. That era distorted investment behavior. From 2022 through 2024, central banks reversed course aggressively to combat inflation. By 2026, capital has a real cost again. This single fact reshapes stock selection. When capital is expensive, companies must earn their existence. They must generate cash. They must justify investment. They must manage risk. Picking stocks without predicting the market starts with selecting businesses that do not require perfect conditions to function. This is why free cash flow has regained its importance. Companies that consistently generate cash after maintaining their operations are less dependent on external financing. They are less sensitive to market moods. They are structurally safer. Balance sheet strength is equally critical. In a higher rate environment, leverage is no longer a neutral tool. It is a vulnerability. Professionals evaluate not just how much debt a company has, but when that debt matures and at what cost it must be refinanced. Companies with modest leverage and strong interest coverage ratios are less exposed to policy shifts and credit tightening. By owning such businesses, investors reduce their reliance on macro predictions. Liquidity provides another layer of insulation. Cash and access to stable funding give companies flexibility. They allow firms to withstand temporary shocks without making irreversible decisions. During every major downturn, from the global financial crisis to the pandemic shock, companies with liquidity emerged stronger than competitors forced into distress. In 2026, liquidity is no longer seen as inefficiency. It is optionality. Picking stocks without predicting the market also means focusing on demand stability. Some products and services are discretionary. Others are essential. Businesses serving essential needs experience less earnings volatility over time. Healthcare, utilities, insurance, core infrastructure, and mission-critical technology fall into this category. Their revenues may fluctuate, but they do not evaporate. This stability reduces the need to guess where the economy is headed. Pricing power further strengthens this approach. Inflation may have cooled from its peak, but cost pressures have not disappeared. Companies that can pass costs on to customers without losing volume protect their margins. Pricing power often comes from brand strength, regulatory barriers, switching costs, or network effects. Historically, companies with pricing power have outperformed during periods of economic uncertainty. By selecting such businesses, investors sidestep the need to forecast inflation precisely. Another pillar of non-predictive stock selection is capital discipline. In the easy money era, many companies pursued growth for its own sake. In 2026, markets punish that behavior. Good businesses allocate capital carefully. They invest only where returns exceed the cost of capital. They return excess cash to shareholders when opportunities are limited. Return on invested capital is one of the most reliable indicators of long-term value creation, especially when growth slows. Valuation plays a supporting role. Picking stocks without predicting the market does not mean ignoring price. It means avoiding extremes. Stocks priced for perfection require everything to go right. That is a form of prediction. Stocks priced with reasonable expectations offer a margin of safety. Over long periods, valuation discipline reduces downside risk and improves compounding. This is not about finding the cheapest stocks. It is about avoiding the most expensive mistakes. Diversification is another practical tool. Professionals do not concentrate portfolios based on macro forecasts. They diversify across businesses with different economic sensitivities. Diversification is not about owning many stocks. It is about avoiding single points of failure. In a world of unpredictable shocks, diversified resilience beats concentrated conviction. Time horizon also matters. Investors who try to predict the market often shorten their time frame. They react to noise. They trade frequently. This behavior increases costs and emotional errors. Professionals align their investment horizon with the business, not the market. If the business continues to generate cash and defend its position, short-term price movements are tolerated. Over time, earnings drive returns. Technology has complicated this landscape. In 2026, data is abundant. Models are sophisticated. Algorithms trade at extraordinary speed. Yet technology has not eliminated uncertainty. In some cases, it has amplified it. Professionals use data as a tool, not an oracle. They understand that models fail during regime changes. Judgment and skepticism remain essential. Picking stocks without predicting the market also requires accepting uncertainty psychologically. This is difficult. Humans prefer stories and certainty. Markets punish both. Professionals train themselves to think in probabilities. They assume they will be wrong some of the time. They design portfolios that survive that reality. This humility is not weakness. It is strength. One of the most powerful aspects of this approach is that it works quietly. There are no dramatic calls. No bold forecasts, no viral moments. Instead, there is steady compounding. Over decades, this discipline has produced superior outcomes not because it predicts the future, but because it prepares for it. In 2026, the market environment rewards this mindset. Easy money no longer hides mistakes. Weak business models are exposed faster. Investors who rely on prediction are repeatedly surprised. Those who rely on structure are rarely shocked. They may experience volatility, but they avoid catastrophe. Ultimately, picking stocks without predicting the market is about changing the question. Instead of asking what will happen next, ask what can endure regardless of what happens. Instead of guessing where markets are going, examine how businesses function under pressure. Instead of seeking certainty, build resilience. Markets will always be unpredictable. That is not a flaw. It is a feature. Investors who accept this reality stop fighting it. They stop forecasting. They start selecting. And over time, that shift from prediction to preparation becomes one of the most powerful advantages an investor can have. In a world defined by uncertainty, the best strategy is not to see the future clearly, but to be ready for it when it arrives.